Welcome back to Rocky Mountain Residential, a podcast from MCM Collective. I'm Kelly McBartlett, and today we're here with Justin Crowley. He's a senior loan originator with First Western Trust. So Justin, welcome back.
Thank you.
So you've been doing this for 20 years now. What's the single biggest shift you've seen in the way that people approach getting a mortgage, would you say?
I'd say the biggest shift is everyone's got their phones. So most of them will either have already checked online or looked somewhere for information. Most of the time it's accurate to a degree, but almost all the time it's incomplete at best and sometimes even inaccurate. So we have a lot of people coming into the process really thinking like they might know a lot about it, but really still needing quite a bit of guidance.
Yeah, interesting. So does that mean they've already researched rates? They have an idea of questions they should be asking you? I mean, what does that look like?
Yeah, most of the time they'll see a TikTok or a Instagram video and they'll say, I want to do that. And so we'll get the phone call of, hey, I want to hack homes and own 15 properties in 15 months. And so a lot of times it's pumping the brakes and really, walking them back to how people really get into real estate. And for first-time homebuyers, though, a lot of times it is, rates and payments and just helping to kind of hone in what that reality is, what their options are, how quickly they can do something. And most people have it wrong, whether it's they think it's going to take a year or two to be ready to buy, they might be ready right then, or they think they can go out and buy $1 million house or a multi-million-dollar house like this tomorrow, and maybe we got to do a little planning first.
Okay. So speaking of those first-time home buyers, what are some common misconceptions they in particular have about the process usually?
The biggest one is that it's a tough process or that it's a painful one. If done right, the lending process is very boring, very easy, very uneventful. It's all paint by numbers if done right. And so if the right conversations are had, the right plans are in place, it's very, very easy. I'd say the other one is that it takes a lot of chefs in the kitchen to get it done. So a lot of first-time homebuyers will have the dad, the mom, the grandpa, the uncle, the neighbor, every person they can think of kind of giving them advice, whether it's solicited or not. And sometimes that can muddy the waters a little bit, that most first-time homebuyers do find just on their own.
Yeah. It's interesting. I mean, it's very similar to walking a first-time homebuyer through the actual homes. Sometimes they feel like they have a good idea of things, and then they want to bring their parents in, and then they end up getting parents out of the way just because it can muddy the waters and make things confusing. So interesting. So what does, for you or in general, what does the typical loan application process look like? Is it difficult? And what does that look like?
It's pretty straightforward. My team and I, we do things a little bit differently from, I'd say, a bulk of the industry. Most people these days, when they go to apply for a loan, they get pointed to some website or some portal. They spend about 30 minutes typing in their information. Inevitably, somebody calls them and asks them all the same questions, and they supply a bunch of documentation. We do it a little bit differently. We do all of our applications live over the phone or in person. Takes a lot less time. It's way more accurate. We can ask more qualified questions because a lot of people will qualify for a different set of numbers and really what they're looking for. So you have people that qualify for way more than what they're looking to spend, people who are looking to spend way more than what they might qualify for at that time.
Right.
And so we tend to just have a 10 to 15 minute conversation to really figure out what we have to work with, what they're wanting to do, and how those two things fit together. And if there's a gap there, we talk about how we can bridge that gap. And then it makes it really easy to list out what kind of options, programs, numbers they could expect if they did something now. And if they're looking to be in a different set of terms, we can draw them a roadmap on how to get there.
Got it. So how do you handle somebody that, a lot of times, especially a first-time home buyer, will go onto their bank's website and fill out a pre-qualification or application sort of questionnaire and get something spit back to them? Your process is different.
Yeah.
How do you handle that? Are they saying like you do it differently? Why?
Well, because I think it's more appropriate for what they're doing. It's like if somebody wants a quick bite to eat, for example, they can pull up to any McDonald's and order the same thing at every McDonald's. But people don't want that with the house. There's a specific thing that they want. Their financial situation is unique to them. Their comfort levels are unique to them. And so you really don't want an automated or one-size-fits-all response to that kind of inquiry. Otherwise, you don't know if you're getting it right. You don't know if the numbers you're giving them are comfortable. You don't know what questions, follow-up questions you can ask or should ask to try to get them closer to the numbers that are comfortable. So again, we try to approach it from more of a conversational perspective of like, well, tell us what the perfect house looks like, and numbers wise, like what's the most you're willing to spend, not only per month, but how much money can you come up with? Have you had conversations with family about if there's any help out there in case gift funds can get you from the house that you can qualify for to the house you really want? A lot of this stuff is missed when people go through those automated application systems.
It's interesting. I've had a number of conversations with people that have done that, and sometimes even the questions are confusing to them.
Yeah.
And they may not know what they should actually be entering in. So it can throw their qualification off pretty substantially in some scenarios. So, your approach, I personally like a lot, but it's helpful to know what you're doing on the back end.
Yeah, because the same term can mean different things to different people, and especially when it comes to things like qualifying income. Like we have a lot of rules and guidelines that we have to stay within, and it's not to offend anybody, but sometimes what somebody feels is their income, for example, might not be viewed as qualifying income, and so. Really getting quality information on the front end is huge, not only to let them know what they can actually expect, but also to avoid, some of the horror stories that a lot of people have told, and, getting under contract, falling in love with a house, and then all of a sudden it falls apart and they can't qualify. And that's why we do it that way, is we avoid that.
Yep.
Every time.
Makes a lot of sense. So when it comes to a loan application, pre-qualifying, pre-approval, there's so many different terms out there that people encounter.
Right.
And some people say, some loan officers or originators will say this sort of approval letter is better than another.
Yeah.
Or, you should really go through this process because it benefits you in this way. What's the brass tacks on that? What does it really come down to? I typically call them window letters, but there's so many different ways to.
Yeah. I'd say, industry-wide, I think, a pre-qual letter is probably the lowest grade of that letter. And that basically just means that person had a conversation with somebody, there's a loan program that they like, and they needed a letter. It might include a credit check. It might include a cursory conversation about, well, tell me how much money you make per year and things like that. But most of those pre-qual letters are either automated or they're generated off of very little, maybe unqualified information. The pre-approval letter is kind of the next step up from there. With a pre-approval letter, sort of the implication is that there's been a deep dive done at some point into, what's in the credit report. How long have they been at their job? What types of income are they earning? Are they salaried? Are they commissioned? Is it both? Have they been there long enough to use both? Are they relying on funds that they don't have yet? That's a more thorough conversation. May not even include any documentation, but it's a much more thorough analysis of it. And then you have a pre-underwrite where basically they're providing documentation. It's being underwritten or reviewed by an underwriter, at least a basic level. And that probably holds the most weight. Of course, with anything, though, it's as good as the person or the company that produces it. So I'm sure there are plenty of places that will get you a pre-underwrite letter, and maybe they still have issues when it goes under contract. And same thing, you might have a pre-qual letter of a buyer that's more qualified than anybody else. So, what you guys, I know you do, and what a lot of good agents do is when they get those pre-approval letters, they'll always make a phone call to really qualify, like, what's behind this.
Right.
And so, yeah.
So what's your advice to people? Should a first-time homebuyer or even somebody that's done this several times be looking for an originator that will provide them with a particular type of letter, or is that not as important in your viewpoint?
It depends on the agent they're working with and the place that they're buying in. My team and I we're pretty unique in the sense that we do loans all over the country. And so there are some markets where it's not uncommon for people to go into a property with no pre-approval letter, no pre-qual letter, write an offer and get it accepted, and then they have a few days to provide a letter.
That is not our market.
That is not our market. That is not our market. Yeah. And then here, most sellers, builders, they don't want to waste anyone's time. They don't want to waste anyone's money. And they certainly don't want to take a property off the market and deprive a qualified buyer of it if someone's not really able to hold up their end of the agreement. So here and in most markets, you want to have at least a pre-approval letter. But more importantly, you want to be able to trust who you're getting that pre-approval letter from. So I always tell people, if you go online, punch in a bunch of information on a form and it spits out a letter, regardless of how confident you are in your financial profile, make sure you have a conversation first before you take that and get under contract, because if something's awry, someone needs to answer for it or help you get through it. And again, those systems just don't do that. So I'd say, as long as you're confident and comfortable in the information that you're getting and the person that you're working with, and that person communicates well with your agent, they're going to tell you what you need and what you should have. I think the more important thing is just to have those conversations early. I mean, it's very common, even in this market, that I'll get a phone call, a frantic phone call at 11 o'clock in the morning on a Sunday. Hey, we found our dream home and offers are due by 2 o'clock. Can you help us?
Right.
Sometimes we can, sometimes we can't. But these are all conversations that can happen well before buyers start shopping.
Sure. Yeah, that's helpful. And, my experience particularly has been, in our region, certain lenders get a reputation with listing agents, that those listing agents communicate to their sellers. And so when they see a letter, regardless of what the title of the letter is, if it's attached to a certain name of the loan officer or originator, it carries weight. And so in our market in particular, that's, very, very valuable. So
yeah, and for better and for worse, so, but yeah, familiarity is a huge benefit if you've got, people that have worked together, at least recognize, the other side. But, also just those phone calls, those, hey, I got this pre-approval letter from you. Who are you? Who are these people? How solid are they?
Right.
I've been doing this almost 25 years. In fact, this September will be 25 years. And I still, on a regular basis, talk to listing agents that I've never worked with before, but they've been around the same amount of time. So those conversations to follow up the pre-approval letter and what we've done behind it are equally as important as the letter itself.
Sure. Yeah, it makes a lot of sense. So, a lot of first-time home buyers or other buyers are, W-2 employed individuals that have regular income, easily verifiable by you.
Yeah.
There's a whole other set of buyers out there that are self-employed or own a business or have different types of income besides W-2. What's important to know about lending with if that's the person that is in that situation?
I think the biggest thing to know is that there are a ton of loan programs out there designed to cater to those people who might not fit in that pretty little box. I've had tons of conversations that start off with, I know that lending requires this and I know it requires that, and that's not us. So I'm pretty sure this conversation is going to go nowhere, but I just keep getting told to call somebody to see if we can buy a house.
And you think that they're saying that because they've talked to another lender, or they put something in, or gone a long time ago or something?
Yeah, exactly.
Okay.
And that's the thing is that, traditionally speaking, you've got this large group of loan programs out there, and 70, 80% of people that get home financing all use the same basic type of loan program. Mm-hmm. And so if you fit in that same box, you're going to be subject to all the same rules and restrictions, but most people fit into that box. But the self-employed person or the freelance person or the person that just moved here from, out of state and started a new business, or that gets difficulty of carrying income that's not taxed and it's hard to document. I mean, there's all these people that are very well capable of buying and paying for a house that don't fit in those boxes. And just to know that there are programs out there that cater to those, I think is the biggest thing. And so again, it's all worth a conversation, and the earlier you can have that conversation, the better. And most lenders out there will have access to those kind of programs. The super big banks, you named one of them. I won't name any others by name.
But you do that.
Yeah, but a lot of the big banks really don't play in that sandbox because they want to, they have to manage at scale. So you can't really get into those niche programs without incurring a ton of risk. Whereas, smaller, more boutique companies or ones that, are comfortable in those loan programs will have things like loans based on, bank statements. There are even like no income loans or DSCR loans where if an investor wants to buy a place, it's more about how the rent compares to the payment than anything else. There's a program for foreign nationals, there's programs for, everything. So it's just worth having the conversation, knowing what's out there. And most people are pleasantly surprised by how those conversations go.
Interesting. What do you see people, in those scenarios, but like we talked about common mistakes with first-time home buyers, but, people in that scenario that have, entrepreneurial income or other income, what mistakes are they making in qualifying for the loans they want?
Yeah, I think the biggest ones that I see at least are that the mindset of an entrepreneur is a lot different from the mindset of a lender or an underwriter. And like for example, a lot of entrepreneurs, because they want the business to survive and thrive more so than anything else, they keep all their money in the business. Or they keep very little cash in the bank and they leverage debt like crazy because to them that means growth. Banks don't like that because that's the opposite of safety and predictability. So, if you can get ahead of the timing, so again, have the conversations early, most of those business and entrepreneurs can make slight adjustments that still keep their business on path. It doesn't disrupt anything they're doing, but it's just showing them in a different light, like, hey, you can still do it this way, but if you can separate some of these assets and put them in your name, or don't rely so heavily on your credit card, or if you do, maybe make several payments during the month so that you're not waiting until you have a $60,000 statement balance to pay it to zero, maybe pay $10,000, every week or something like that. Little adjustments like that can drastically increase the number of options that they have or the simplicity of the process once they get there without really derailing their other plans. I'd say the other one is paying a bunch of stuff off and depleting their cash, kind of going back to the mindset difference. With real estate, a lot of times just having more additional funds available is going to expand someone's options or reduce what their cost and rate might be for a particular program, more so than simply eliminating a couple payments here and there, especially if that payment is to the business anyway, because a lot of times if you can show the business is making the payment, we don't care about it. So it's little stuff like that that can make a big difference.
Interesting. Yeah, super helpful. It seems like every situation in that scenario is very different. So it's
Very different.
Yeah.
And it goes back to, typing in a form online is not going to allow you to have those detailed conversations to really figure out where those opportunities are.
Well, I've seen, in my experience, sole proprietors sometimes really view that business income as their income. And so like if they go to an online portal, they might be putting in that full amount
Or the top line revenue, not net.
Yeah. And it can really throw things off there as well. So interesting.
Yeah. And on that real quick too, and this is timely because today's tax day. We have a lot of really in-depth conversations with those types of folks, either around this time every year or at the very end of the year. Because the other thing is that there are a lot of different ways that people can report their income and their expenses. And sometimes their CPAs will give them options on, let's say they bought a piece of equipment. Do they depreciate it? Do they write it off? Do they wait till next year? And there are ways that information can be reported on the tax returns that change how we as lenders are allowed to interpret it. And so we have a lot of mortgage planning conversations, as we call them, to where if we have somebody that's either getting ready to buy a place in the future, or maybe they're kind of getting their ducks in a row to do it next year, we invite them to bring us into those conversations so that the CPA does say, here's two different ways we can file your taxes. Here's the pros, here are the cons. And we can also weigh in of like, well, this way might be more favorable for your loan application. This one won't. Not that we tell them how to file their taxes, but a lot of times if it's up to the buyer or the taxpayer as to how they have their CPA file it, sometimes those decisions can make a big difference in qualifying for a loan as well.
Super interesting. And so like a takeaway from that for me would be, if you're in that scenario where you're thinking in the next year of buying a house, have that conversation in January with you and the CPA, or even December of the year before, because usually this moment in time in April or May when this podcast comes out, it's too late. Your taxes are done, and you could have maybe depreciated that asset in a way that's not at to your advantage. Yeah,
Exactly.
okay. Do it early. Makes sense. So switching gears a little bit, another type of buyer that seems to have really complicated loan scenarios is the move-up buyers. So maybe they bought their first house, 10 years ago, and they're wanting to move on in their life. They have, kids now, or they just want their next dream home.
Yeah.
But they've also not far enough along in their career that they have a ton of assets available to them. And a lot of the assets they'll be using for the next house is tied up in their current house.
Yep.
And so that creates oftentimes in our world a scenario where we would say that property is contingent on their home selling. How should that person approach things?
Yeah.
Go ahead.
I mean, again, one size doesn't fit all. So we see a wide array of situations that kind of create that same dilemma. And a lot of those move up buyers, they're in that situation you described. Most of them, the move isn't something that they're doing because they want to do it. It's a lot of times they're doing because they have to do it. They got another kid come in, they're sick of this house, they're sick of the neighborhood. A lot of move up buyers have a reason why they want to get away from their old house that's as important as why they want to get into a new house. And so that adds a degree of stress to it that's usually not there in the first time home buyer pool. But we really look at, okay, what are the options? It's the same kind of conversation. How much equity do we have in the house? Do we have access to any temporary money if we need to buy a place first and sell later? Conversation of family. Every now and then, some generous uncle will come out of the woodwork. Hey, I'll help you with this bridge, because that's what they're called, bridge loans, where you're borrowing against the equity of your home to buy another one. There's also bank financing options, loan programs that provide for bridge loans. But it's really just that conversation of, okay, where do we want to be versus where we are right now? And if we can't sell first and buy later, how do we do it in reverse order? And in most cases, we can find a comfortable way to bridge that gap. But it all comes down to, just, again, making sure that we have all the pieces in play, making sure that the numbers are comfortable. And also, and more importantly, I think most people right now are most concerned with, how do I limit the risk of buying the place I want to be in and then not being able to sell the house that I'm leaving, and I have to now carry these payments forward. So we really try to get in depth on what that looks like and the things that they can do to mitigate that risk. Obviously, that's where you guys come in, of making sure they have a realistic idea of what that house could sell for and what they might need to do if it doesn't sell right away. But it's definitely a much more in-depth and delicate conversation versus the first timer, because we're dealing with two homes and not one.
Mm-hmm. And a lot of times it's really comes down to risk mitigation and like risk tolerance, because our first scenario or our first approach might be to secure that next house with a contingent offer on their last house selling, and hopefully that pans out. But in a lot of scenarios, sellers are not willing to work in that scenario, and people don't want to lose, miss out and lose the house that they really like. And so then we're looking at other options like you just talked about. So are you finding more people come to you once they're in that situation where they've made the offer and it's not accepted contingent, or are people talking to you about that up front and, looking at the possibilities of, can we do this without having to sell our home?
I think it's kind of 50-50. A lot of people that already own homes, and this isn't all of them, but a lot of them kind of feel like they get it. They understand the process, and maybe they bought at a time when contingencies were more the norm. And so, like, I just had a conversation yesterday with a couple where, they were just shocked that the seller wouldn't accept a contingent offer, and they hadn't even considered or planned for the likelihood that they would have to figure out a way to buy before they could sell. And so, I think that most of the people that find themselves in that situation kind of don't plan on ending up in that conversation.
Right.
A lot of them do. I would say the best ones are the ones that have the conversation of, hey, if we're going to do this on a contingency, what does that look like? And just in case we find that perfect house where we have to go non-contingent, what options do we have? Because in the pre-approval process, you're basically approving them for both of those. So that way they can just go out there and find the place that they want. And if we get a contingency accepted, well, we go down this path. If not, then we've already got this path laid out. But yeah, there are a lot of people that have to figure it out in a hurry.
Yeah, it's good advice to just maybe if you're thinking about making that move, have that conversation up front, even if it's not your preference. Have it just what your resources really are. So okay, so we talked about a lot today. There's a lot going on in the market right now too, in terms of lending, real estate, everything else in the world. What's your advice to borrowers right now?
I'd say, don't get sucked into the panic of the day, I guess. I mean, over the years, I mean, you throw in COVID, you throw in post-COVID when rates were shooting up, wars, tariffs. I mean, you name it. It's like there's no shortage of things that you could get wound up about.
I mean, even looking further back, subprime lending,
Yeah, all that
the
stuff.
Great Recession, that
Yeah.
that has all happened in
Yeah.
the last 25
Yeah,
years.
and I'd say, the housing crisis was a little bit of a different story because you had kind of this sinister problem just building and building and getting to the point where the size of the problem was bigger than the size of the real estate market, and no one knew about it. And that really caught people by surprise. And so, you had some devastating things happen at the tail end of that. But other than that, I can't remember a single event or, cycle that we've been through where the noise was always worse than the reality. And so, yeah, these days there's no shortage of things that you could get upset about. There are definitely, these days more so than ever, there's no shortage of people who will tell you what's going to happen if their prediction comes true. And so, I always tell people, like, go outside, go for a walk. You'll notice people are still walking their dogs.
Right.
Builders are still building homes. Kids are still going to school and coming home. I mean, life goes on. And so, if now's the right time to buy a house, or if they want to plan for that in 6 months, 12 months, 18 months, whatever, you can't use the news of the day to guide that or, sort of steer that decision. Just do it, get in the best position you can be in so that when that house comes up, you're in the best possible spot to make it happen at the lowest possible cost with the least stress. That's the best formula.
Yeah, great. Well, thanks, Justin. Appreciate you being here, and always great to have you.
Thanks for having me again.
Yeah, absolutely. We'll see you all next time. Thanks.